if anything was going to lift the U.S. recession, according to many market observers, consumer buying likely would help retailers. So we have 3 different areas here with the as moved to the upside. The first, of course, we talked about the ways we want to look at, and that is this area right here of getting into a long-term position. This little box here, we're going to focus at on the first part. Then we have a situation where the market kind of turns a little bit sideways, a little soft. Is it a market you want to stay in? So that's where we have to make a decision moving up, whether we're going to stay, whether we're going to get out, kind of what we want to do with our money and where we might want to invest it. And then the third stage, of course, we got up here a little ways and move up near the previous all-time highs, is a situation where the market turns, and it turns down, pretty vigorously. It was maybe not a pretty picture. We had some very volatile days in early March. We abandon this trade, get out, and say that we had our loss, and that's about all that we can expect. So we look at what we're talking about today to analyze these markets. We need some help. We need something that kind of gives us a little bit of what we can expect in the longer-term situation. I'm going to be using today Vantage Point Intermarket Analysis software. Vantage Point Intermarket Analysis software is, useful for short-term forecasts. A lot of times the short-term forecasts that it provides, perhaps will also be useful because you need to have the short-term forecast to get it in right, to get out right, and so forth. But you have the right kind of situation shape up. When you do get into the market, you can then have some staying power for that long-term move that you're looking for. Now, a couple of things about Vantage Point that I need to point out, and that is that Vantage Point data is based upon intermarket analysis. That means they take the 25 markets or so that influence the target market, and with a neural network determine which of those other markets have the most influence, and then the degree of that influence, and kind of what is going to occur in the other markets that will influence the market that we're talking about. And secondly, when we're talking about the markets, we want to look at the situation that occurs with the predictive indicators, because that's kind of the basis of what we're talking about when we're looking at the Vantage Point charts. In this case, we're talking about predictive indicators using typical prices, and typical prices is the average of the high, the low, and the close. I know you know that most analytical software is going to use only the close, but computer analysis has determined that the most useful data that can be provided is a typical price, because it includes all the price action for a given time period and shows you a little bit more, a better feeling for the overall trend and what potentially could happen. Now we're going to turn over to our Vantage Point screen. We're going to talk about Vantage Point. We're going to be shifting back and forth between Vantage Point, and we're going to be looking at several different types of periods. And first of all, as I mentioned earlier, we're talking about the earlier time period. So the thing we need to do first is we need to use our Vantage Point screen to get a little custom design work done here and to cut back our time frame. We're going to start, as you can see on the screen there, with early June, but we're going to cut the time frame that we're looking at all the way back to, let's say, the end of August, because we want to make this large enough so that you can see what's going on in the market and why we would do certain things too. Okay, now we have about a 3-month time frame here in which we're going to look at, try to analyze how we get aboard a trend first. That's the first stage. We need to get in. We need to get in at the right point. When we look at the charts, we're talking here again about looking at how not only Vantage Point would look at it or how we would look at it, but we need to know what is the typical traditional chart trading observer. What are they looking at? What do they see on the chart? Where are they going to have their buy points? What are they going to do at specific points? When we're talking about that, let's say that we're just a traditional trader out there, traditional analyst. We're looking at our charts and trying to decide what we're going to do. The first thing we're probably going to be looking at in terms of what's going on in the potential market is we're going to observe what looks like there a W bottom. Now this W bottom that you have here, where you have the market kind of swing down and goes back, and it swings up, swings down, and back up. Traditional analysis would say what you need to do then is trade above that highest point that you have in that interim high period right there. Okay, so looking at that, let's say we put a line across there and we're going to jump on board this if the market moves above that. That's kind of how a traditional trader might look at it. So if we were looking then at this particular point, that signal might come in at around 79, maybe a little bit in that neighborhood right there at 79. Now, if we're looking at a traditional chart stand outlook, we're also going to be wondering where to place a stop. And let's say that our stop logically would be below the low that we have down there. And we're just, to get it in round numbers, we're going to say that's at 74. So you have a difference there of approximately $5. Now, it depends a little bit, again, here on your risk-bearing ability and what you would like to do. But even if you look at this, let's say that you have a $20,000 account and you have a guideline of risking no more than 2% on a given trade. In this case, that 2%, of course, would be $400 or $4 per share. So you can see right off the bat that you couldn't even buy a 100-share ETF if you stayed within that risk criteria and using this particular entry point. The other entry point that people are going to look at, probably from a traditional standpoint, is going to be the previous high that we had, a little bit earlier, and that's going to be in the neighborhood of, let's say, 82. Again, to just round off the numbers, the previous high was at 82. So some people are going to be a little skeptical because of the way the market was unfolding in the spring of 2009. They're not going to jump on board until they really are convinced that this trend is potentially going to move higher. So they might not even get into 82. So you can note that the difference between 82 and 74 is even more beyond the capability if you were using some typical risk management guidelines where you want to keep your risk within 2% of your account. So we're going to now show you what we would do if we wanted to come into this market, if we wanted to use the vantage point analysis to try to capture some of this trend. Get in first at the right price. Again, only thing we're concerned about now is getting in at the right point. We're not worried about this longer term trend because obviously we're looking at the situation in hindsight, so we don't even know if that trend exists. At this point, all we're trying to do is get into the trend at the right point as early as we can. And we're making an assumption based upon some of our other analysis, based upon the market choices and so forth, that we are in a situation where we can buy and hopefully hang on for a longer term trend. The first vantage point indicator we're going to drop on the screen here is going to be the predicted medium-term moving average. The predicted medium-term moving average is based upon, again, the intermarket analysis, the predictive indicators, and we're going to be talking